The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey everybody, this is the Tax Lady from EG Tax, and this is our half hour to talk taxes. And if you've been listening to the news, you know everybody's talking about taxes, but this is where we give you the straight scoop in advance before everybody else is panicked about it, so that you know really what's happening. So if you have any questions and you want to join us to voice your opinion or to talk about any issues, our phone number here in studio is 803-0930, 803-0930, star 930 on a cell phone. And I got my crew here. I got Tiffany Fabian.
Hey, Esther, and I just want to say my heart and thoughts go out to the families of the school shooting. I just wanted to say that. Nice to see you.
It's terrible, isn't it? All those babies, you know. And Christopher Fabian, you must be related, brother and sister.
No,
husband and wife. And Tiffany's my right hand guy, and Christopher is our district manager, so he's my left hand guy. And Steve Jacobson, our assistant district manager, is Chris's right and left hand guy. Right?
I don't want to touch that one. I don't know what exactly that would entail. Essentially,
but Steve just went this week to a seminar on the Affordable Care Act, and I thought it would be important for everybody to hear a synopsis of really what's coming down the pike. And we know that it really is completely phased in another year. 2014 is when it's fully phased in. But we thought it was important for you as taxpayers and you as business owners to know what's really happening. And I will tell you, you can call EG Tax or visit our website, and we will help you, especially if you're a small business owner and this is something you're looking at and you're going to have to pay if you have more than 50 employees, and you have to pay the penalty if you don't have health insurance. Or if you're an individual and you're looking and you don't have health insurance and you really don't want health insurance, well, baby, you got to get health insurance. As a matter of fact, I read an article today that New York State was just approved for the health care exchange.
Yep.
And starting in October next year, they're going to be offering it. So for people that are looking for health insurance. But give us a brief synopsis of what you learned this week, Steve.
And this is, guys, just so that you know, it's everything with all the guts taken out of it, so that it's not crazy for you guys, so that everybody can kind of understand this here. But here it is in brief. First of all, there are two kinds of penalties that are going to be out there, those for businesses and those for individuals. On the business side of it, if you have more than 50 full-time employees, you might get hit with a penalty. And the kind of penalty you're looking at is about $2,000 for all the employees minus the 30 employees that you have. For each employee. So for a quick example here, employer has 80 employees and doesn't offer any health insurance. That would be a $100,000 penalty if they didn't offer anything. Okay. Now, if they did offer insurance, but it was minimum coverage and they were maybe charging too much or something like that for it, normally, if people go through the exchange, you wouldn't have to pay a penalty. However, there's this wonderful little clause that if one person makes under 400% of the poverty level, which 400% of the poverty level is for a family of four, $92,000 some odd dollars, you will then have to pay not only a penalty on that person, but all the people in your company going through the exchange. So that same situation of that 80 people, let's say out of the 80, 50 people go through the exchange, he would then have a penalty of $150,000. So it's actually better to not offer anything than to offer the minimum. And
really, that's really what's going to happen. I was just, we were talking this morning that one of the other situations is because you get a refundable credit if your wages and your total income is under 400% of the poverty level, which is a lot of money.
Right.
People are actually going to get refunds for paying health insurance, right?
That's absolutely right.
So actually an employer would be smarter to say, you know what, Steve, I'm going to give you the $3,000 I was paying on your health insurance. That increases your wages. You take that $3,000 and buy your insurance, and then they give you a refund.
That's right.
So you actually make out.
And it works out, and that would kind of work out for the employer a little bit too, because these penalties that the employer pays out are not deductible on their business return.
Right.
And so it's really important for businesses to tax plan too, and to look at this, right, Stevie?
That's absolutely right. Now is the time to kind of figure out what you want to do.
We figure next summer we're going to be doing, because by next summer everybody's really going to get their head in the game, I'm sure, and we'll start doing seminars regarding the Affordable Care Act.
Absolutely.
And I use the word affordable tongue-in-cheek. All right. What else we got?
The last thing I'm going to briefly talk about, because these are the two important things, are not only does your boss pay a penalty, but guess what? You could have to pay a penalty too. Now, like we said, there are some refundable credits out there. But a quick kind of example here, basically in short, we're going to go by 2016 because that's the worst year essentially. So in 2016, you would have to pay a penalty on each member of your household of $625 or 2.5% of your income, whichever is higher. But there is a maximum that you could pay, which is around $2,085. So let's say you were a family of 5 people, you would actually then have to pay that maximum because you're over that threshold.
But that's only if they don't get insurance.
And that's only if you don't
get insurance.
Right.
So the penalty isn't assessed unless you don't get insurance. So when you're listening to this, see, you have to get health insurance.
That's right.
Even if you don't want health insurance, you have to get it, or you're going to pay on the back end a penalty, which is most of the money you'd pay for the insurance.
And that's why Obamacare got through the Supreme Court, was because you could ultimately say, I don't want it, but guess what? You're still going to have to pay for it. And the other neat thing that I found out at this conference is the IRS only has the ability to take whatever refund you have to offset the amount that you owe Obamacare. But they can't go after you if you owe the money to them, so they can't collect on you, they can't go and seize your bank accounts, and they can't press criminal charges against you. So for tax planning, what you should try to do every year, if you think you're going to have an Obamacare penalty, is owe money every year and then write a letter of protest saying I'm not going to pay it, and they can't even collect on you right now.
Right,
But the theory behind that is though what they're ultimately is going to happen is they're going to say, well, nobody's paying us for it, so we're just going to have to raise taxes. So,
yeah, but the bottom line is most taxpayers like to get a refund, and so that they don't like to owe the IRS. So anyway, if you have any questions on Obamacare, the Affordable Care Act, you want to talk about taxes, year-end tax planning, the financial, the fiscal cliff. Our phone number here in studio is 803-0930, 803-0930, star 930 on a cell phone. And the other thing is we wanted to tell you are things that we know that will happen in 2013.
Yep.
Like number one, the FICA tax holiday is gone. Now, what does that mean, Chris, to people?
What that means is your paycheck is going to get lower. You're right. For the last 2 years, you had a 2% break on Social Security. So for every $10,000 you made, you saved $200. You got $200 more in your paycheck.
And even self-employed people who had to pay their own got
a reduction on their tax return. So if you made $50,000, you actually brought home an extra $1,000 for the last 2 years.
And so we know for sure the 2% holiday is going away, and so next year that person's taxes would go up $1,000. Somebody making $90,000, their taxes will go up $1,800.
Yep.
Right? Okay. Another thing that's going in 2013 is the change in itemized deductions for medical expenses.
Right. Exactly.
Which means what?
Which means that it's going to be harder to get that Schedule A deduction. It's already hard enough now trying to get 7.5%. But for those of you who are a little bit older, over the age of 65 by the end of the year, you'll be grandfathered into that 7.5%. But for a lot of people who maybe have some big medical bills or maybe paying for their own insurance, it's going to be very tough to get a deduction out of that now.
Because it'll be 10%.
10% of your income.
10% of your adjusted gross income
and
for everybody under the age of 65.
Correct.
Starting in 2013.
I was going to say, but, that the large health insurance cost will be now an affordable health insurance cost, so there's nobody will be able to qualify.
That's in 2014.
Or whatever. All right, let's we're gonna continue with some of these other things so that you will know what's happening. But we got Tony and Clarence holding. Hey, Tony, how can we help you?
Yes, it's good to hear that you're a little better, Esther, but just take care of yourself.
Well,
because
you know what it
that's
is my
you.
grandkids came on vacation over Thanksgiving, and two of them were coughing and snorting and sneezing, and I thought, I feel really good. I'm not going to catch it. And sure enough, 3 days later, I had the mother of all colds.
It was
But I'm
inevitable.
good now. I'm really good. It's just good for pity, Tony, really. So what can we help you with?
Let me just say this. There is a flu problem going around the area because I was at Veterans the other day, and I was told that by one of the nurses in the allergy clinic. The situation is this. I have a friend that works at Veterans Hospital who's a nurse. And she just told me to ask you this question. She has in a will is going to receive $20,000 in savings bonds. That's the face value of the savings bonds.
Sure.
And she wants to ask what would be the best way to handle this money. I mean, I told her I'd ask you this
Sure.
question.
No problem. No problem. Chris, you want to answer it?
Yeah. Well, Tony, the inheritance is tax-free. But when she goes to cash them in, she's going to be paying tax on the interest. So
on the interest?
on
Just
the
on the interest.
Yep. So for $20,000 in bonds, depending when they were purchased and how old they are, and
It might be 10,000 in
right.
interest, right?
If it's a base, you could have a lot of interest there. She needs
Now-
to do
and it's
tax
tax-free on the
planning.
same.
Right. Now, I will tell you the decedent can make the election to pay the interest in the year of death on those bonds. So maybe your friend would want to go back to whomever it is that's doing that final return who can make the election to pay the interest on those savings bonds, and then your friend would get them tax-free.
Yeah, but the person is dead.
I know, but the person...
When did the person pass away, Tony?
January of this year.
Yeah, then
Right.
they can.
So
then
the-
this is the year they can make that election.
If the bonds are cashed in now, you can make the election to have the deceased person pay the tax on the
Right.
bonds.
In other
Oh,
words,
you mean out of their estate?
that's
Correct.
correct, out of their estate. So the
of
thing
their
is,
estate?
see, many times a person who's deceased is elderly and they don't even owe any taxes. And so the truth of the matter is, if the interest were put on the deceased person's tax return, it may be better than putting it on your friend's return who is a working person. And you really don't know until you look at both situations.
Well, I know that she told me she earns between $55,000 and $60,000
so
a
it,
year from
it's
the
not, it
hospital.
may be
And
if this was an elderly person who passed away, it may be
And
better
it's-
for her to
Right,
for
and
the estate to
especially
claim
since
it.
the person passed away in January, there's probably no income.
Right. So it really is going to be better for it to go on the decedent's return.
All right, I appreciate
You're
that.
welcome,
Thank you
Tony.
so
Thanks
much.
for calling.
Take
Bye
care.
bye. And that's what part. The tax code is very complicated. Everybody's talking about that, but that's a great tax planning tip, because let's say $10,000 the only income that goes on that decedent's return. There will be no taxes.
Yep.
On her return, it might be $2,500, and with it'd be tax free in the state of New York. But I mean, $2,500 is a lot of money.
Definitely.
I'm Esther Gulius, the tax lady. 8030930 is our phone number here in studio. 8030930 star 930 on cell phone. And I know we have people holding, but I wanted to talk about things are going to happen next year. How about the cap gains rate?
And the capital gains rate is going to go up. Right now, it's from 0 to 15. It's going to go to 20%. And if you make a lot of money, there might be even an additional 3.8 surcharge on capital gains. So that's important to know.
And Stephen, then talk about the 0.9% surcharge.
Well, the 0.9% surcharge is those that make over $200 if you're single, $250 if you're married, $1,000 during the year. And what happens is once you make over that threshold, you're going to pay an additional 0.9% Medicare tax. So instead of 1.45% coming out of your check, it's going to be 2.35%.
Right, and then of course there's going to be a different schedule for that too.
Right,
Yeah.
and that's combined income. So if your wife makes $50,000 and you make $249,000, no one's getting taxed out of their paycheck. It's going to be a tax on their tax return.
Well, the husband will get taxed on the first $49,000,
Okay.
but then they're going to have to pay that overage on the tax return. You're absolutely right.
Right, and so that's coming down the pike. We talked about the penalties. The child tax credit is going to be reduced to $500
Right, instead
for
of
children
1,000.
under the age of 17.
Yep.
Right?
Yep, absolutely. That's a huge hit. That's 50%.
Right. Now, if Congress, and it sounds like they're sashaying up to extend the Bush tax cuts, if Congress extends the Bush tax cuts until like April, then we would still have potentially the $1,000 child tax credit in there. But right now, it looks like it's going to be $500, right, Chris?
Yep.
All right. And then student loan interest.
It's $2,500 right now. It's an adjustment up to $2,500, an adjustment on page 1 of the 1040, and that would be completely gone.
Well, no, actually, it goes back to the original rules,
sorry.
which means for the
Years.
first 5 years. So it's only for people who are paying student loan interest for the first 5 years.
Correct.
I learned so much from you guys.
And then how about education credits?
I love how they put it at the seminar I went to. They said American Opportunity Credit is gone, but hope returns. That old Hope credit where it was $1,800 a student.
Actually,
for the
Hope
first
was phased out, so it's only the lifetime learning is out there.
That's
but
interesting.
no,
No.
Because I think
It's-
Hope will
but
come
I know
back.
what I remember reading on this, and they said the Hope's gone. The only thing that's going to be left is
Is
a lifetime
lifetime learning.
Oh, that'd be interesting. There's so much different conjecture out there, and that's the problem.
How about the marriage penalty?
Marriage penalty will come back. So, normally if it's like, let's do easy example here, $5,000 is standard deduction for a single person. Normally it would be $10,000 for a married couple, but now married couples it would be 1.5 times, so $7,500.
So in other words, it's so starting
gonna
next
be
year,
harder
it's
to
going to
get
cost you more to be
harder
married.
to get Steve to walk down the aisle.
Oh, I know. Well, it's hard to get Steve to walk down.
Oh my God. What am I on
Anyway,
eHarmony's
I know
dating
we have
show?
people waiting, so we're going to go back to the phones. 8030930, 8030930, star 930 on a cell phone. And Bill's been patiently waiting. Hey, Bill.
Hey, how are you guys doing this
Good.
afternoon?
What can we help you with?
Good. Two questions for you. I'm a Canadian citizen.
Okay.
I've been in the States, a legal resident. I've been in the States for, coming up 16 years in May.
Okay.
And I just wonder what this Obamacare, can they force this on me being a Canadian citizen?
You file as a U.S. citizen, do you not?
U.S. resident?
No, I'm not.
Do you
a US
file a
citizen.
1040
Don't
or
you
a
file
1041?
1040?
Well, I'm not working right now. It depends. When I was working,
If-
it was 1040, I believe.
If you're a U.S. resident, then yes, this would apply to you.
Right.
So.
See, the thing is, if you don't have any taxable income, then it doesn't make any difference. Okay? You don't have to worry. But if you have taxable income and you file a U.S. return and you're taxed as a resident, then all these things would come under your situation.
And so, Steve, am I right? He has to have health insurance, and I think in Canada you are offered health insurance, right, Bill?
It would have to fit a certain qualification. So, I mean, their qualifications may be different than what our qualifications are.
Right.
So, it could be a slippery
But I will
slope.
say this, Bill. Right now, there's a ton of regulations that nobody has really deciphered yet. So we're telling you based upon what we know right now. But it sounds to me, if you have no income, you don't have to worry anyway.
Yeah, if you're below the filing
Well, I'm
threshold.
unemployed now. This will be next year that I file for, the 13th or the year 2013. So,
Well,
like,
when
I
you're
hope to
taxed
work
as a
in-
U.S.
I'm
citizen,
on-
if you're taxed as a U.S. citizen
Sorry?
resident and you're doing a 1040 form, it would seem to me that based upon what we see, that you would have that situation. You'd have to pay
I
it.
don't understand how I'm a Canadian resident, and if I need medical assistance,
No,
I go
you're
up
a
there.
U.S. resident. You're living in the United States,
Right.
right?
Right.
But see, I can go up there to a walk-in clinic and pay
Do-
$45.
it doesn't matter as long as
you're.
you're
And I got to pay $170.
you're working you're working in the U.S. and you're living in the U.S. You are a resident of the United States, and that's the way they look at it. Otherwise, the only option I got for you is you can try going back to
there
Canada.
may be an exclusion that they come up with
know.
when all the regs are written, but right now that's the way it looks. Okay, Bill? Thanks for calling.
And the second question,
Yes,
real
sir.
quickly.
Yeah.
Second question. Unemployment. I just got a letter from the state.
Yep.
They said that if Congress doesn't pass this cliff, over the cliff thing, that my unemployment stops on the end of the month.
Right.
30th.
Yep.
Right.
The extended benefits have
Because
stopped.
that's the extended benefits.
Right.
Yeah.
So that'll end on the 30th.
And
Right.
he actually is.
See, and that's why
for everybody.
that's why this is called a fiscal cliff, because everything that people have come to enjoy in the last 10 years and all the handouts that everybody's been getting, it doesn't just trickle away. It like comes to a bang, a stop.
Right.
And on top of
Well,
that, you
I'm
got
on-
sequestration And I mean, and then the Obamacare stuff is coming in, so it's a big problem.
Yeah, and Bill, the truth is, you are making wages. You're making unemployment, so he is making wages.
That's true, but he might not have enough.
Well, I am currently. Unfortunately, I am.
Yeah,
hopefully
and so
I
that
can
would
get
be,
something
and
here
so
soon.
that's taxable, right?
Yep, it is.
Got 2014. You got till 2014 to run back to Canada, Bill.
Thanks for calling. And we're going to go to Sal in. Nope, I'm going to go to Mark. Mark on a cell. Hey, Mark, how can I help you?
Yes, I have a question for you. I work for a local union, and we're self-insured. Okay.
Yep.
And there was a thing, and I can read some of this, but you're a lot more literate on it than I am because there's a lot of mumbo jumbo in this. And I'm single. It's basically if you put more than $7,000 or $10,000 towards your health insurance, you can get taxed on a Cadillac tax.
Okay, that was something that they were proposing, but that has not passed. Okay?
Okay.
So
because
right
I'm
now,
wondering,
you don't have to worry about that. But, Congress is looking for new streams of income, so that may come back to haunt you. But right now, you don't have to worry about that.
Oh, well, the only reason I was wondering because I'm single.
Right.
And single or married, we put so much in, and they take $16,000 a year on me in health insurance. So if they pass that, the extra anything over 10, they can tax me on upon the 10, or if that does pass.
Well, but I mean, you
it
never
hasn't,
know.
though.
See, right now, I would only be a guess because I don't know what they're going to do. But they were talking about people that had really good insurance. The thing is, they may take it out of your benefits, but it really is it's all pre-tax, right? This isn't money that you were paying taxes on and they took it out.
It's all
This just
pre-tax.
right. So that's why it would end up being a potential tax. But right now it isn't. Right now, I think they have bigger fish to fry, Mark. Quite frankly.
Okay, I was just wondering. I'm thinking.
Yeah,
I'm
right.
paying
You
this much
should.
and they want more.
I know, but you got to understand they're looking for money. They're looking
I
for
know
money.
this. You ain't telling me nothing I don't know, Mitch.
Thank you, Mark. Have a great
Thank you
Christmas.
very much.
Wanted to talk about some other things. I know we have Sal waiting in town.
Yeah, one thing, you hear every year this time of year the AMT patch.
Right.
Right now, you talk about them making money. If they don't fix the AMT, you're looking for people whose income is $45,000.
paying
Like
alternative
Mark.
minimum
Minimum
tax,
tax.
right?
Yep.
At 26%. So you figure 10,000 over would cost them $2,600. That is a truckload of money.
Yep. I mean, you have a single mom, 3 kids. She makes $50,000.
Right.
Kids count against the AMT.
Right.
So she's going to get stuck with the AMT. She's losing $1,500 for the child tax credit.
Right. This is in
I mean,
2013.
but they're only raising taxes on the rich.
Well, see, but that's what's so I hate to say this, but you really can never trust a politician. Half the time, I don't think they even know the tax code.
Yep.
Because I'll sit there and I'll listen to them and I'll say, no, that's not right.
mean
Anyway, I wanted to tell you this. We know for sure, we deal with the Internal Revenue Service. Every year they keep pushing back the filing start. Like this year, we're not being able to file tax returns until January, 21st?
22nd.
But they
January
have this
22nd.
modernized e-file, and everything's supposed to be faster and better.
It used to be that we'd start e-filing on January the 15th. Now we can't e-file till the 22nd. Next year, when they're phasing in all these tax whatevers, they're saying that it's going to start even later.
Yep.
And refunds are going to be held up longer. Okay, so what we're suggesting is that maybe you ought to change your W-4. Now, not that you haven't heard us say that before, so that you stop getting big refunds, so you get your money as you earn it, so you're not sitting around waiting for a refund in 2013. That's not going to happen
Absolutely.
until way later,
Absolutely.
especially with cost basis on stock, right?
Oh my gosh.
All right. And then the other thing is there's more stringent due diligence. In other words, if you're somebody with an earned income credit, you have to prove the child lived in the house.
Yep. It's on the new form for us
The
professionals.
8867,
Couple
page
pages.
4.
Yep.
And then the other thing is, you don't forget that the federal government, whatever happens on the federal, the state of New York parallels. So if it's bad news on the federal, it's also equally bad news on the state. Yeah. And we live in a very low tax state.
Yeah.
All right. And we're going to go back to the phones. We're going to talk to Sal. Hey, Sal, how can we help you?
Well, I was self-employment tax. My grandson and his mother deliver papers, and I know you can deduct mileage and the orange bags, plastic bags that they have to purchase to stuff the papers in. I have a question on the cell phone. They use a cell phone to call the news frequently, and during the day when they're during the morning when they're delivering papers, they're out at 3 in the morning. My grandson's constantly communicating with his mother because
Sal, there's good news. You absolutely can deduct the cell phone use. What you want to do is there's 100% use of cell phone, so you want to allocate the portion that they use for that business and say it's 20% of the cost of the month, and you times it by how many months they've been doing it throughout the year. So absolutely. And don't forget, if they buy a new cell phone for the year, you can depreciate a portion of that cell phone. So the answer is yes.
Right.
Okay,
I mean, assuming that it's ordinary necessary, which, like you said, would be ordinary necessary.
Right.
So yes, and then that would help them reduce their overall taxes and FICA.
And don't forget, maybe internet. I know sometimes they have to log onto the site or they have to do MapQuest. So if there's internet use too, there's a percentage of that. So there's lots.
Yeah, and
lots
if they're
of things.
mailing their receipts in to the Buffalo News or whatever, that's all deductible as well.
Money in, money out.
Okay.
Right. Okay, how do you get the percentage of a new cell phone if they just bought one?
All right, so let's say that they're using just let's say 1,000 minutes in a month.
He said if they bought a new cell phone.
Let's say they're using 1,000 minutes in a month total, and they're using 500 of it to do the papers. That would be 50%. So if the new cell phone was 400, 50% of 400 is 200, and that's what you would depreciate.
Oh, thank you very much.
All right?
Appreciate it.
All right, thanks,
Thank
Sal.
you. I appreciate your help.
No problem. Thank you. Now, during the week, like let's say your head is spinning, you don't know what to think, you don't understand about the fiscal cliff, you don't know about the fiscal cliff, you're wondering about the Obamacare thing, EG Tax is there to help you. And as part of what we're doing this tax season, we're not only just doing your tax return, but at the end of the interview, we're going to say, now look at Sally, you have 3 kids. This is going to be a change next year. This is going to be a change next year. You have no health insurance. This is going to be a change in 2014. And we're going to help you to plan so you know how these gigantic things that are coming down the pike will affect you and your family. And that's part of what we do. And so during the week, you need us. Visit us at egtax.com. Call us at 632-7886. We're in your corner. And until next Saturday, I'm Esther Gulias, Tiffany Fabian, Chris Fabian, and Steve Jacobson from EG Tax. Have a great week. Bye-bye.